Hi, everybody. Hi, Yash. Hi, Avinash. Good evening, everybody. Thank you all so much for joining us. While I know there's a fantastic match that is alive, we really, really appreciate you guys jumping and plugging in today to talk all about stocks. And hey, Yash, over to you. Hi, Avinash. Thanks again for plugging in.
Yeah,
Yeah,
what's
thank
up,
you.
man? I was about to discuss discuss the match only. The KKR 44 for 3 after 6 overs.
We'll give regular updates so that you guys don't miss out on the other action that's happening. This kind of reminds me like I was on a flight at one point of time, and the pilot was very nice and considerate to give us an update every half an hour. I'm like, excellent.
Awesome. So just as people just join in, just a quick intro about Stocktwits. Stocktwits, guys, is the largest social network for investors and traders. Our mission is to power the global conversation for investors of traders of all levels in order to connect, learn, profit, and have fun. We recently raised $30 million in Series B funding from FTX, and the co-host is Ashwin Raghunathan from Business Insider India. And our guest today evening is Avinash Gorakshakar, Director of Research at Profit Mart Securities. Avinash has been in the markets for over 25 years and worked with several top domestic brokerages like Edelweiss, Kotak, and MK. An out and out fundamental guy, Avinash has a solid grip across multiple sectors, especially mid caps and small caps. So, thank you so much, Avinash, for taking the time out and speaking with us.
Yeah, thank you, Yash, for inviting me.
All right. So, Avinash, let me just kick things off. We asked this to our previous guest as well, Safar Anand, on the 2 year anniversary of the COVID bottom. It it truly has been, once in a century kind of an event. What were your learnings and experience along the way, if you can share them?
Yeah, I think Yash, the COVID, which happened, about 2 years back, and which actually impacted almost everybody. In fact, financially as well as economically. My greatest learning is that these kind of events, first of all, cannot be predicted by anybody. So one has to always keep some margin of safety when one looks at investments or anything you do in life. And clearly, my learning was that as far as the equity markets are concerned, is that never play and construct your portfolio in a very concentrated manner. Always try to diversify. Have your portfolio allocation always right, and most importantly, in equity markets, it's rightly said that the bounce back for equities happen only when there is some sort of sustainable business. There is a sustainable kind of cash flow which happens in the business. So I think investors who actually played on mid caps, on penny stocks, on companies which had got very poor balance sheets, very poor corporate governances, managements. I think clearly this clearly tells us that if you want to invest in the market, then you got to play the game by its rules. You cannot be a superhero. And even I have committed some mistakes, like in mid caps typically. 2017 was a year when it was a very horribly bad year, and obviously a lot of money got lost. So I think looking at good quality management, looking at good strong company balance sheets, and plus understanding the business is more important than the stock price. Many times investors get carried away by pure momentum. I think momentum is important. Everybody wants to make money in the shortest possible time, but equity is all about making wealth in the longer term. So, my learning is very simple, that you got to move in the markets, you got to stay invested in the markets for a longer period of time. Wealth creation happens, but to expect a kind of a rerun of 2020 or 2021 and 2022 would be a little premature. So I think, keep your sights, well sighted for the longer term. And I think, short term rewards could come in, but anything which comes in the short term is not sustainable. So that is what I would like to say, that stick to your basics and stick to data has got a very strong correlation in the markets, and without that no trader or no investor would actually bet on any company across any sector. So without data, I think if you bet on any company just on the narrative, I think that is not going to help you over the longer term.
Avinash, one of the things that Yash said was that your deep expertise in the markets for the last 25 years. And while Avinash is going to, while Yash is going to largely talk about stocks and sectors, I really want to talk a little bit more about the culture of investing, which I think is far more interesting from a business insider's perspective. I really want to understand, how are people approaching stocks? How are millennials approaching the stocks as opposed to, Gen Z and the earlier, in the sense that I'm in my 40s and my investing habits are pretty much like my father, who's the older generation. And younger people, how are they looking at stocks? Help me understand the culture out here.
Yeah, Ashwin, I think you had a very pointed question. I think, in the last 2 years when COVID happened, we had got a lot of these Robinhood investors who entered the market. Now, basically, the definition of Robinhood investors is people want to make money in the fastest possible time. And, the new generation of, youngsters who are entering the markets are obviously getting more excited by, trading opportunities. I find very few friends, from the younger generation actually having the patience and the maturity to actually look at, stocks from a wealth creation point of view. Because unfortunately, whether we like it or not, the feeling of instant gratification is getting more and more stronger. People are looking at TV channels, they're looking at trading experts every day, so they believe that a 10% move in 10 minutes is nothing great, and you need to make at least 20-30% in a month. So I think these kind of signals are coming from the younger generation, and what I feel is that in any equity market, any participant has to experience some failure. See, I've been in the markets and I've seen cycles of Harshad Mehta, Ketan Parekh. What we have seen is that unless you lose a lot of money in the markets, the market does not give you bigger rewards. So, unlike, the older investors, as you said, to, invest like your father's style, the new Robinhood investors have never seen a bad market. They've never seen a bear market. I've seen 2004, I've seen 2008. In fact, 2008 was one of the most horrible kind of years for any equity participants. In fact, the job market was equally horrible for people who are associated in the equity market. So I think the younger generation still looks at equity as a momentum asset class. Very, very few people are really interested in the longer term. And that's the reason you see even on most of the TV channels, you see a lot of people actually following trading experts. There's nothing wrong in it, but at the end of the day, my sincere belief is that if you don't look at equity as a long-term asset creation kind of instrument, you're going to miss a lot of opportunity, because youngsters have got a lot of productive timeline to their careers. Uh, Obviously, if they invest properly, they can retire rich. They can retire rich early. Most of the financial independence happens only when you enter equity markets at an early age. So these things are yet to catch up with the masses. Unfortunately, we don't have equity as a subject in schools or colleges, and that's the reason, the first mistake which most youngsters make is they enter the markets with a trading approach, and unless and until and when they make a big loss, then they realize their mistake, and then they gradually become long term investors. So it should be the reverse. And obviously, it all depends on the aspiration and on the investment appetite. Youngsters are more risk friendly. They don't mind taking bigger risks today. Only thing is the margin of safety has to be there. We have always seen, what has happened in case of valuations, for high price companies. Valuations are going to be the key monitorable for any investor going forward. So I think, Ashwin, in a nutshell, I would believe that, with whoever I talk as of now, the younger generation is raring to go very aggressive in taking, bigger bets and risks. But I think one needs to also look at equity from a long-term perspective, which I think the younger generation just has to learn a lot. Experience also matters in the markets. I think just having a 1 or 2 year experience in the market is not going to make anyone rich. So you need to also fall down and then evaluate your mistakes and then move forward. So net, I think this is what I feel, what the younger generation is actually doing. And this may, continue for some more time, unless and until, investors really want to make a big shot in the market. They'll have to go through these cycles. And once you go through a bad cycle, then only you emerge stronger.
Just a curious thing out here, Avinash. Has the definition of what short term and long term changed over the last decade? I mean, in the sense that for a new term, for a new investor, are they thinking long term is 3 years? I mean, has that perceptual time frame or time bracket altered in your understanding?
Yeah, I guess the way the markets have rolled in the last 2 years, Ashwin, long term has become extremely short term. In fact, there are many friends whom I talk regularly. Long term is 3 months, short term is 1 month, and if you want very very short term, then even it is hardly a week. So
Good Lord,
basically,
that's worse than I thought. I was thinking you'll
so
tell me long term is 2 years, but oh
no,
well,
no,
I
no.
stand
See,
corrected.
It
basically,
depends on the asset class also. If it is crypto, it might just be a couple of days.
yeah,
Arey,
yeah. See,
in crypto, though, 2 months is forever, yeah. So
no, I think, see, one thing is very clear, Ashwin. Long-term definition has changed because today, people have seen stocks multiplying in no time. We have seen a lot of examples, and that has given extra confidence to the younger generations that even the impossible is possible. But I think what youngsters or the new investors should realize is that you can't be on a sound wicket if you just want momentum in your portfolio. I think momentum can come, but it has to come gradually. Rightly when I said whatever you get in life very easily, that is not sustained, and that obviously evaporates very easily. So that should be the kind of guiding factor for the new age investor.
Thanks for that, Avinash. That was really, really insightful.
Yeah, awesome answer, Avinash. So coming back to markets, Avinash, majority of global and domestic events like Fed rate hike, UP election, and more or less the Russia-Ukraine war are now behind us. What, according to you, is the next big trigger that will drive markets higher?
Yeah, I think Yash, my guess is that in the Russia-Ukraine war is definitely discounted now by the markets, but the culmination of the war and the war getting over is not yet fully discounted. My sense is that today we have seen a good amount of buying from the FIs, but if you see the Russia-Ukraine war, clearly if it gets over within a week or 2 weeks or maybe another 2-3 weeks, then one can expect a very strong short covering rally at least in the near term, and that could make everybody happy. But I think the next big challenge for the market would be the impact coming from the Russia Ukraine war. There are lots of commodity prices which have gone up, especially if you look at metals, if you look at petroleum prices, if you look at cereal prices. My guess is that what is going to happen in the next 3 to 6 months is wherever Russia and Ukraine exported these commodities, these are going to be pockets of opportunities for Indian companies. I was just reading some data on the internet, which told me that Russia is not only exporting crude, but it is a large exporter of even steel and metals. And I think the metal cycle could definitely get elongated for a long time. India is a very large steel producer, so obviously steel exports could get a significant amount of kicker going forward. And at the end of the day, we are also going to see a lot of commodity price increasing, impacting sectors like automobiles, or for that reason even FMCG companies, oil marketing companies, paint companies. So all these developments are going to be looked upon very seriously once the Russia-Ukraine war gets over. In fact, the fourth quarter numbers, yes, are going to be very, very critical, from a management commentary point of view, because I think already management like HUL, Asian Paints, they've already sounded that inflation costs have gone up, and these are not easily going to be passed over to customers. So I think that is going to mean a significant amount of margin dent for these companies. So I think it's going to be very selective, stock specific as well as sector specific. On a broader market basis, I would believe that 18,000 could be a near term kind of resistance point, and I think beyond that you would require a huge amount of earnings kind of recovery kind of drive to actually push up stock price. So I think this is going to be a year where stock specific and micro specific investment is going to play a very big role. The index is definitely not going to give you that kind of return what it gave you in the previous year, that is in 2021. Nifty was up by almost 21%. So on an index based level, I would believe that we could be in for a very close range kind of market. But yes, stock specific opportunities are going to come in. What is going to be bad for one sector is going to be good for the other sector. So one has to obviously now juggle around the sectors and obviously have your asset allocations done in a very optimal manner.
Interesting. I mean, talking about the Ukraine war at this point of time, we heard that there's going to be some rollback, but there are most reports coming that there are more attacks happening. So anybody's guess is good as to what's going to happen in the immediate future. But thanks for that insight there, Avinash. Just a curious question. You said a while back you said people watching pundits on television. Uh, 10 years back, when I was with business television, we assumed that there are people watching, the scripts and the tickers all the time and constant, calling their, brokers and telling them, "Ye kharid lo, wo bech lo." I really like to know what is the scene right now as to what is influencing this current generation when it comes to having an opinion on stocks. I mean, how much does social media make an impact on how people are, perceiving sectors and stocks, and where to make their investments? Do you have people calling you and telling you that, hey, we saw this on social media, what you should do this? Help me understand, how is social media driving the markets?
Yeah, I think Ashwin, this is a very interesting question, and I would be honest enough to tell you that people don't look at my Twitter handle that seriously. Unlike if you're a technical trader or if you're an FNO trader who gives regularly good kind of short-term tips. Unfortunately, Twitter has become a kind of a bedrock of information. 10 years back, we didn't have much information on the internet, and I remember in my old days, I think Ashwin, you must be aware. BSE had a corporate directory, a company directory, from where we used to get, small data points for companies, for
Yeah.
sectors.
Yep.
And of course, that product is now no longer in circulation. And I think the younger generation may not be aware, of this directory, which it used to sell, commercially as a separate product to investors. The point which I'm trying to drive is that today there is no dearth of information, but unfortunately, from where the information comes out, how authentic that information is. There are many Twitter experts who are not SEBI registered. They give, very promising kind of statements on Twitter, saying that I made 100%, I made 50%. I think unfortunately the retail community, the trading community still follows such pundits, and there is no accountability. There is no regulation actually to control these guys. So social media has definitely become a very big kind of source of information, even for trading, for investments. But I think at the end of the day, I think investors forget one fact, that they need to do a little bit homework on their own also. I think today information is not a problem. You get lots of information, lots of research reports, lots of WhatsApp groups, lots of Telegram channels. I think what is important is that we need, investors who actually can do a little bit of homework, a little bit of reading, because without reading, my sense is wealth creation is just not possible. You cannot address the equity markets or maybe the trading markets also if you don't read at all. So my guess is yes, Twitter, electronic channels, Telegram channels have become a huge source of information support, but how genuinely they help in creating value is something which is quite questionable. So I would be on the side where I would believe that whatever I put out on Twitter is honest and obviously straightforward. There are many guys who actually try to blow their trumpets, who try to give big promises in terms of advisory or maybe in subscription. I would believe that investors or traders who follow such people should be very careful, and this is definitely a positive trend, because every input on internet has got some positive and some negative. One has to stay away from the negatives. That is my advice to the new age investors, who want to actually make a lot of wealth creation. Please do not believe anybody at face value. Please do your homework and take your call.
Does that annoy you, unregistered SEBI investors giving stock tips? Does it come in the way of you doing your work when you've gone through the information and you're making an educated response, and you have somebody who calls you and says, "Acha, मैंने Twitter में देखा." Does that bother annoy you?
No, actually, Ashwin, I don't get such phone calls or any kind of input. But yes, I do get some inputs from on my Twitter handle saying that, sir, I've benefited from your recommendations. Sir, what's your next investment call? Can you share it with me? And as far as the unregistered experts are concerned, Ashwin, I genuinely don't like to waste my time on such guys, because see, at the end of the day, when you're going to be a long-term investor, you should focus on what you know best. I think what noise is happening around you is immaterial, because if you get carried away in that noise, then you will not be able to concentrate. And equity markets are markets where there's a high amount of volatility. There's a lot of homework which we need to do on a daily basis. So I think at the end of the day, the net result of what you do is going to be reflected in your work. I mean, without putting in genuine quality work, I don't think anybody on internet or anybody on any other social media or electronic channel will actually respect you and give you that credit. So I think the unregistered guys will continue. I mean, that's a fact of life. But I think one needs to be very careful of what these guys actually put out on Twitter, because 99% of their stuff is all false, and there is some genuine material interest when they put out something on a particular company or a particular sector. And unfortunately the retail investor gets trapped. That is something which happens every bull run and in every bear market. So I think one has to take precautions from one side. You can't afford to say that this has to stop completely. There would be occupational hazards, and you got to take care of those occupational hazards in a very optimal manner.
Lovely. Thanks for that, Avinash.
Avinash, the biggest headline this week has to be the PVR Inox merger. Obviously, we will discuss about the Axis City deal later on as well. But if you could give us your high level take on the whole film exhibition industry and the multiplex market, and what do you make of the merger announcement?
Yeah, I think yes, this merger, my sense is it has happened because COVID has taught these multiplex companies that anything can happen anytime. Most of them, or maybe none of us, could have anticipated that suddenly one fine day there could be a lockdown, and the business could have dried up significantly. This not only impacted the film producers, obviously a lot of companies which were there in the film production chain, and obviously the multiplex owners. So I think COVID has also resulted in this merger happening. Of course, the second reason is that you're going to get a very huge kind of company with a huge kind of screen presence, almost 1,500 screens together. Inox and PVR would command. And looking at their expansion, I think they're not going to stop there. So, in a country like China, there are more than 70,000 screens. In a country like India, we still have about 9,000 odd screens. So, the growth opportunity for a country like India, where movies are very, very popular in cinema houses, I think the growth will definitely happen. And I think this is probably, to capitalize that growth in a much bigger and a profitable way. So, my sense is yes, the merger has happened because of first is the OTT business has taken off significantly, and OTT, players have started buying a lot of companies' rights, obviously, which earlier used to not happen about a decade earlier. So obviously, the OTT business is now started eating into the margins of all the cinema offline players, and that is why this merger is going to give a significant amount of pricing power to this joint combined combo of IVR and PVR. So typically, if you ask me, how is this going to benefit the shareholders? The best part is that the pricing power would improve, their F&B business would improve, their negotiations with the film producers would improve. How this gets reflected in the numbers, Yash, is going to be seen post FY23, because you're going to see a lot of consolidation, both from the balance sheet point of view, both from the employees point of view. And I think there are going to be a lot of expenses which are going to be cut down. See, when there are two companies, you all will appreciate that a lot of costs get duplicated. So you're going to see definitely some margin improvement coming in by cutting down some duplicated costs. And secondly, obviously, as the number of screens increase, the pricing power is definitely going to significantly move up. So you could see bigger, higher ticket prices. You could see better negotiated kind of deals with the movie producers. And obviously, the F&B business will continue to roar better, because as you have a more better geographical presence, that will obviously make this business even more profitable. So my sense is, looking at the valuations of both these companies, maybe the near term may look, both the stocks may look, quite expensive. In fact, Inox went up by 20%, immediately post the deal announcement. So if you're looking at the next 2 to 3 years, Yash, my sense is that this could be a very large opportunity where the runway is going to be very significant. And this is a growth sector. So obviously, you're going to see a lot of action. And fortunately, whether crude oil prices go up or steel prices go up, this is one sector where the customer is more than happy to pay a premium if he wants to see a movie, either for a Salman Khan or a Shah Rukh Khan. So clearly, I think this is going to be a very strong merger. At the end of the day, next 2 to 3 years is something which investors will have to patiently wait. But yes, on the downside, yes, the execution of this merger and obviously the margin improvement coming in from this merger are two critical data points which the market will observe very closely. So maybe the next 2 to 3 quarters, the market should definitely start asking the company management that what are the improvements in terms of EBITDA, what are the productivity gains which the merger has brought about, and how quickly this execution happens. Because once the execution gets scaled up, and obviously the execution continues at a much faster pace, that is the time where possibly the re-rating could happen further. So as of now, I would say that yes, it's a great business, it's a great merger, but the real benefit of the merger could come in after the next another couple of months.
Avinash, I only heard you say higher ticket prices, and I'm not very happy about that. But I'll figure out how I can deal with that sadness. Thanks to all of you who have joined us today. At this point of time, the cricket scores are 70.6. That's KKR at 70, having lost 6 wickets. I'll let you guys decide if that's a good score or a bad score. But Avinash, one of the ads that I've been seeing on television over the past few days, right, is about how stock markets are for everybody. And there's a young lady who holds her phone up. And that had me thinking. Uh, 10 years, 15 years back, right, the stock market was largely seen like something that has mostly men in it. Has that changed over the last couple of years? Do you see more young, more women coming into the markets? When you look at the kind of investors that you talk to, has this gender parity changed?
Yeah, definitely, Ashwin. I think about 10 years back, equity markets were a closely guarded club. Although there was a decent amount of retail participation, but in the last say 3 to 4 years, equity markets have opened up in a big way. The first reason is with interest rates not going up anywhere, I think there have been very limited opportunities for investors to actually make money which would beat inflation. So I think that is the single most factor. There are very limited number of alternative, investment options now available with investors, and that has made people actually take out money from fixed deposits or term deposits and actually put money, on the equity markets, where obviously a certain amount of risk is also attached, but obviously the risk reward is much better. So I think this trend is going to gather definitely stronger momentum as investors get more educated. They come and start building assets in the financial system. I think a lot of money is still invested in gold. A lot of money is still invested in real estate. A lot of money from those sectors has actually started coming in here. We have seen a lot of good amount of SIPs. In fact, just to give you a data point, in this month, I was told that FIs have sold almost stocks worth about 50,000 crores in the Indian markets. But on the other hand, SIPs have helped the domestic mutual funds to buy stocks to the tune of almost 40,000 crores. So this was never heard, in the previous 5 or 10 years. So obviously the equity cult has started moving very, very fast, and I think people have realized that equity is an asset class which can generate good amount of returns over the medium to long term. As far as your question on women investors, I would believe that generally whatever I have learned is that women are also equally or in fact better investors than men. They know how to invest their money, and I think the educated woman today is very clearly aware what she wants, what is the risk profile, what is the risk appetite. So I think it's going to be a great opportunity for even Indian women to enter the markets. There are many Indian women who are very good traders. There are many Indian women who are very good investors. So I think it doesn't matter whether you are a male or a female. I think at the end of the day, today the equity markets are an ocean of opportunity, and I think even women have realized that if they want to make a decent amount of money, then either it is mutual funds or the direct investment route. I would not be surprised that in the next say 5 to 10 years, you could find that maybe the number of lady investors could actually double or treble, because the base is very small. Even now, the field is dominated by the male investors. So I think it's a good kind of opportunity. I think the market will expand. You will see a lot of new investors coming in the market, and I think this is generally going to be a good positive development for the growth of the capital market. So I think net Ashwin, I would believe that yes, you're going to see a lot of new investors coming in, but clearly, as I told you, I mean, most of the investors who come in only for momentum are the ones who get hurt, very badly. So you need to build investment portfolio. You need to build a proper process in your investment, and that is something which obviously comes with a period of time and experience, and only then wealth creation from equity is possible. But yes, the longer term trend looks positive.
Awesome. Thanks for that, Avinash.
Avinash, we get a lot of questions on social media about Tata Alexi and what a run that stock has had, right? Almost 10x in the last 2 years. What really is driving this optimism, and what is your advice for investors now?
See, my guess is yes, obviously, in the last 2 years, it's gone up by 10 times. It's a great business even as of now. But yes, valuations have become slightly pricey. And I think the main reason for this is that, it is not a typical IT service company like, let's say, a TCS or a Infosys or a HCL Tech. They are basically into, three, four important segments like media and entertainment. They are also into, medical equipment. They're also into automotive, driverless cars. So a lot of R&D has gone behind, building the business model of the company. And most importantly, recently I read some news on WhatsApp that Tatas are going to launch, their, the Tata app possibly on the 8th or 9th of April. So possibly that was also one of the buzz for, this stock to, suddenly move up. Clearly, if you look at the earnings and if you look at the order book for this company, they are sitting on an order book at least for the next, say, 2.5 to 3 years. So clearly, in terms of the revenue visibility, they're very well positioned. Any investor who wants to buy this stock and actually make a decent amount of risk reward, yes, I think he'll have to wait for at least a couple of years, because today, the story is well known. Almost all the institutions, whether it is domestic, FIs, some HNIs, have already started, building stakes in this company. So, if you have a 3 to 4 year kind of roadmap, obviously, any decline in the stock is definitely a good opportunity. But yes, I would like to also caution investors that please don't get carried away by what is said in the media. Past performance is not a guarantee to make money. You have to monitor the company every quarter. Every conference call probably is something which gives you a good opportunity to interact with the management. So my sense is, I mean, anybody who has the shares should just hold on. I mean, you're going to see explosive growth for the next say 2.5 3 years in terms of earnings growth. But yes, new investors should actually use any market decline to actually accumulate this stock.
All right, and moving from the bullet train that Tata Alexi is to ITC, obviously in recent days and in the last 1 month, it has done extremely well, up almost 20% on the top gainers on the Nifty. What really is happening over here, first of all? And secondly, do you think is it too late to buy ITC now?
Yeah, I think yes, my guess is it's moved up from around 209, 10 odd levels to around 250 level. So it's not a very big rise in percentage terms if you look at the other comparable brick and mortar companies. I think the bigger issue is that this was a company which was completely ignored. People used to make fun of this management, and clearly for some time people used to feel that having this stock is actually not meant for you but for your grandchildren, because that was the way the returns used to be looked upon. I mean, the current market scenario has actually, resulted in some sort of re-rating for this company, because all of us know that there are some businesses which are not going to be impacted whether the Russian-Ukraine war ends tomorrow or whether it continues for more than a month or two. Most importantly, this company has always believed in rewarding its shareholders. If you look at their dividend payouts, if you look at their cash flows, if you look at their operating margins for the cigarette business, although operating in a sin business of cigarettes, their cash flows and their operating margins have been the highest in the industry. So despite being a sunset industry, I think the management has been doing a lot of efforts in restructuring their business, moving more into FMCG, moving more into hotels or the paper industry. I mean, anybody who has a 2 to 3 year view can even think of investing even at the current odd level, but you need to have a huge amount of patience here. Unfortunately, once the stock has moved, only then people have got excited here. We recommended the stock at 175, 180 levels. At that time, nobody even looked at our note. But then today it's gone up to 250 odd rupees. Now suddenly it has come in the limelight. So I think one should not just follow momentum. If you really want to put your money in a stock like ITC, take a 2 to 3 year view, because growth is definitely going to come in. It is going to be sustainable. There is hardly any debt on the books. But I think what the markets would like is that when can the business be restructured? When could you see only a ITC in a case of a FMCG company or a paper company or a hotel company? For that, I think you'll have to wait for the next couple of years. And I think the management is very serious on this. Someday, I think they'll definitely realize that this needs to be done. And I think only in the interest of shareholders, I think this once this restructuring happens, then you could see the next level of re-rating. But I think just buying it for the sake of because it's moved up by 30-40%, and then getting onto the ITC kind of stock would not be a right way. If you have a long-term approach, then I think it should be part of your long-term portfolio, because this is a very low beta stock, and whenever the markets are volatile or there is some panic sell-off, you will find that this stock does not fall that significantly like the other high alpha stocks. So basically, it's not a high beta stock, but a steady investment. So somebody who's got the patience to hold on for next 2 to 3 years could definitely look at it. But traders and short-term investors would possibly not get anything much out of it, from the current.
Yash, when you said ITC, I was a member of ITC Sonar, and Avinash, I should ask you this. 30 years back, my parents' generation, Site, Sona, and stocks were your portfolio diversification. What does that look like today for first-time investors? Two questions, really. In fact, I have two things on my mind. Talk to me about how portfolio diversification is happening, and is gold still exciting?
No, I think gold has definitely lost its shine, Ashwin, because see, if you look at the percentage rise in gold vis-a-vis the percentage rise in equity, the percentage rise in equity has covered, inflation significantly. Gold has not done it, and gold, unfortunately, whether we like it or not, it's a hedge against basically, some sort of solvency risk. And gold only does well when there is some sort of a economic crisis, and it is a hedge. So basically, when somebody puts money directly in gold, one can be safely assume that it's basically for a social purpose. Gold cannot be quantified as a kind of investment which can give you multiple returns in the next, say, 3, 4, or 5 years. So I think, typically, if you ask me that how investors have now decided to strategize their portfolio, see, most of the equity investors whom I talk, everybody wants that they should bet on growth oriented sectors and not on sectors, which are possibly going to grow in their mid teens. So typically, ITC maybe 30 years back was a very, well known, well established brand, and most of the older generation could say that yes, this was one of my earlier stocks. But today, what the market wants and what the investors want is basically growth momentum. Typically, Ashwin, just to give you an example, whenever we analyze companies and decide to get into some new investment, we look at what is the kind of earnings growth expected over the next, say, 2 to 3 years. Typically, companies which double their earnings growth in the next 3 years or in the next 2 years are ideal re-rating candidates, and this is where multiple expansions happen. So, if you have a company where the earnings growth is going to double in the next 5 years, that is something which is not going to excite investors. So, I think this is something which is now followed by most of the investors. In fact, we also follow this. Unless your earnings growth engine does not grow faster, that earnings actually double in 3 years or 2 years, the other companies which fall in the fourth year or the fifth year, earnings growth getting doubles, that kind of stocks are obviously ignored because people would obviously not pay a higher valuation to such companies. So I think portfolio valuations are going to definitely revolve around this important metric. And I think this is something which is very important for investors when they actually start building positions in new companies. Unless you know what is the earnings growth engine going to be in the next say 2 years or 3 years, just buying a company because the P multiple is low is not going to make money for the investor. You need to know how strong the earnings growth momentum is going to play out and what is unique about that business. See, buying a business which is basically a sin business is something which is not going to be liked by many. In fact, today, although liquor companies are also liked by the markets, ITC is in a sector which is basically like a sunset sector. Like today, globally, everyone is aware that cancer cases are rising. Cigarette smoking is actually globally being discontinued. So I think this is one company which is operating in a sector which is not going to see a very high kind of growth rates. Obviously, it will grow in mid-teens, but that is not something which will actually make it a multi-bagger. So I think the bottom line, Ashwin, is that you have to be, obviously investors also would, agree to this, is that you need to be in sectors which are going to grow significantly and obviously make a lot of money for investors, which would be actually be reflected by their earnings growth and by their, revenue growth, which is going to be the most important elements, when we look at it, any company from a fundamental point of
So, what do you make of the IPOs that have just happened recently, Avinash?
view. I think my guess is, see, if you are asking me about companies like Zomato, or if you're asking me companies like
Yep,
Paytm,
all the young new age ones. Absolutely.
I think Ashwin, these guys have been very smart in selling dreams to the investors. Basically, Mr. Vijay Shankar Sharma has made a lot of money. The IPO price was 2100. Today it's 500 rupees. So people are wondering what exactly went wrong. But I think the biggest important point which I think all of us missed out when this IPO came out is that only the narratives was positive. I mean, the next 5 years or 10-year opportunity is very big, but the current position of the company is extremely, is very weak. I mean, if you look at the operating EBITDA, if you look at the cash flow, these companies have not generated anything meaningful in terms of financial numbers. So I think today you cannot run any business. Forget about Paytm or Zomato. You cannot run any business if there is no cash flow in the business. We are investors, from the old economy. So people tell us, Avinaji, you are a very conservative guy. You only look at cash flow. But unfortunately, cash flow is the backbone of any business. So if you look at Paytm, you look at Zomato, you look at Policy Bazaar. In fact, Policy Bazaar has been in the market for last 10 years and still they are making losses. So I would believe that, unless and until the company makes a decent amount of operating cash flow, just, looking at the company on a price to sales multiple basis actually is just like an illusion because there is no meaning. If you just generate revenue, but you don't generate any profit, Ashwin, I think eventually people are going to obviously get disappointed because today Mr. Vijay Shankar Sharma has gone on record saying that we'll make the company profitable as soon as possible with a huge cost structure and a huge kind of fixed cost structure. I would not be surprised that these companies could take at least 2 to 3 years before they actually turn profitable. So I think you're going to see a lot of de-rating in these companies, and I think whoever holds these companies has got no choice. But unfortunately, they bought in these companies at a very high level. So my sense is, this kind of dream which got sold out from November 21 onwards. Now the new IPOs which come from most of these internet companies, like MobiQuick or some of the other names, are going to be extremely careful when they value the business. If you get the valuation right, then I think there could be a chance where you could look at companies like Nika or you could look at companies like MobiQuick. But unfortunately, valuations are something which have always favored the promoters. So I would believe that it's still not a right time to get into these businesses because unless and until we see good amount of cash flow generation, these are all companies which are operating on PE money, and PE money is not going to last forever. So that is the bottom line. So unless these companies become profitable, they start generating cash flows. See, revenue generation is of no meaning. In fact, somebody, recently about a couple of days back, I think you guys must have also read, Mr. Aditya Puri, who was the ex, managing director of HDFC Bank, has said that Paytm has not got customers because of the services, but because of cashbacks. So, such kind of customers will never be loyal. they would only come when there is some cashback offered and not because of a service. So that shows how hollow these companies are. So I would say that it's still a little more time before one can look at these companies, because valuations still don't seem to be in the right position where one can take a fresh position in these kind of companies.
You're right. People are definitely a little bit more careful after what happened in November, December, January. So I think this is definitely sound advice. Thank you for that, Avinash. Yash, over to you, sir.
Avinash, I'll come back to the news today about Axis Bank coming out on top in its three-year battle with Kotak Mahindra and HSBC to acquire Citigroup's India business. What would be your strategy for the counter, given that it may open with a big up move tomorrow morning?
Yeah, I think my guess is, if you look at the deal, Yash, of Axis Bank, this is a very, very promising deal for, Axis Bank. First of all, they have a card portfolio of almost 9,000 crores. They have almost something like 80 to 19,000 crores, in their loan book, which also comes to Axis Bank. Most importantly, they've got 50,000 crores as deposits. They've got a huge amount of network in terms of ATMs. They've got about 500 odd ATMs. And I think, this business is definitely going to scale up their CASA also. A lot of HNIs, a lot of corporate, employees had accounts in Citibank. So obviously, net, if you look at the next 2 years, this is going to be a very strong kind of a, acquisition for them in terms of the EPS accretion. So maybe tomorrow you could see the stock, moving up purely because of this news flow. But if you look at the numbers, once the, Citibank acquisition, this acquisition gets added to their balance sheet, I would believe FY23 and FY24 should be a lot better in terms of the asset, kind of growth, loan book growth. And most importantly, the CASA growth could be significantly better. So I think net, it's a great deal. And I think markets would definitely welcome it. So I think even somebody who has not bought in Axis Bank should look at, accumulating this stock even at the current level. Because, if you look at ICICI Bank, or if you look at the other banks, private sector banks, I think this is one bank which had underperformed significantly. So now with this acquisition, I think significant amount of re-rating looks possible, and I think the asset which they have purchased is definitely a very good asset, and that would definitely drive valuations, going forward.
Uh, is my audio okay now?
Much
I
better,
believe
much
there
better.
was
I
a bit
don't
of
think
echo.
it. Yeah,
Yeah.
I don't think it's acting up anymore. Yeah.
Yeah. Avinash, we've heard this a lot of times already by now that 2022 won't be as easy or as 2020 or even 2021. In that context, what are some of the themes and ideas that you are tracking or you are bullish on for the rest of the year and beyond?
Yeah, I think on an index level, as I told you in my introductory remarks, that one cannot expect a 20 to 25% move on the index. But yes, there are going to be a lot of sectors and stock specific opportunities. So I think we are looking at several themes like QSR companies. We are looking at companies which are into electric vehicles. We are looking at companies which are into SaaS, that is software as a service. We are also looking at hotels, as well as typically hospitals and some large IT companies. These are pockets of opportunity, yes, where I feel that the growth of momentum could be significant, especially private sector banks, PSU banks. Looking at the opportunity in the kind of infrastructure spent, I would believe that private sector banks, as well as the PSU banks, are now very well positioned. Asset quality, for banks like SBI have also come down quite significantly. So you could see a significant amount of re-rating here. Most importantly, companies which are there in the QSR space, despite the fact that valuations look little pricey, but if you want to keep a 2 to 3 year kind of view on the sector, then I think there are very good opportunities which are available. In fact, now just in the previous 3 4 years, we just had Jubilant Foodworks, but today you've got a host of new players which have come in the markets, and I think technology is going to play a very key role. We are finding that a lot of companies are using cloud kitchens, they are using a lot of technology to cut down their costs. So obviously, we are going to see incrementally, profit coming from these companies in a significant manner. And obviously, as I mentioned, there are not many companies which are into software as a service. I mean, the frontline companies have been companies like Intellect Design, which recently got a very large order from RBI. But there are some newly listed companies. I would believe that we had just recently met this management, this RateGain Technologies, which is one of the largest player in the hospitality and the car rental space in US and Europe. Now, if you see the operational numbers have been pretty solid. The stock was issued at an IPO price at 450. Currently, it's available at around 340, 342. So my guess is, I mean, this could be a very good linear opportunity to get into a very large growing space. And yes, I think most importantly, hospitals are one area where I believe that despite COVID now completely getting over, the specialty hospital space, somebody like a Fortis Hospital, or maybe even a Narayana Rudalay, or maybe for that reason, even an Apollo Hospital, we are going to see a lot of focus being given by the government here, and specialty is going to drive the EBITDA margins of these players, despite being the fact that it's a fairly capital intensive business. But I think players who have got a very good geographical reach, a good balance sheet, would obviously see better times to continue in the next, say, couple of years. So I think, these are themes, yes, which we believe are not going to be impacted by crude oil or by interest rates or by the commodity rise in prices. So this could be a much better bet to play on. And one sector which got left out was the pharma sector. I think pharma sector, especially companies which are exporting in a big way to the US, I think we could see definitely strong kind of tailwinds happening there, because clearly, after a long period, regulatory issue wise, I think Indian companies have well settled down there. So I think probably, from the US basket, something like a Lupin or something like a Sun Pharma or something like even a Torrent Pharma could possibly do well. So I think this is also one opportunity which investors should start looking at these levels, because where we believe the risk reward could be significantly better. And I think this kind of portfolio restructuring, Yash, could definitely ensure a decent risk reward over the next, say, 12, 15, 18 months, considering that volatility this year is going to be quite significant. We are going to see a lot of volatility from commodities, and commodities, wherever there is a where it's a raw material for many companies, it's going to obviously impact their profitability significantly. So I think this could be a more of a kind of a defensive and a kind of a growth combined kind of sector portfolio, which I think investors should use in these kind of markets, because what is important according to me is returns will come provided your capital is safe. So I think apart from the margin of safety, capital allocation and margin of safety is very important. So that would be my approach to look at the markets as of.
Avinash, you discussed about QSR briefly. We've done these spaces multiple times. We hear names like banks, chemicals, IT. QSR not so much has come up in discussion. Obviously, reopening is another positive trigger. What would be your pecking order now that we have more names other than just Jubilant Foodwork in this space?
Yeah, I think, yes, we actually had some interaction with the management of Devyani International. My sense is that this is a company which is part of the Varun Beverages promoter. In fact, the same promoter runs this business at around 160, 170. My sense is that the stock has run up recently, slightly, because of good quarter three numbers. But I think the incremental upside for this business is going to be quite solid. In fact, on the management call, the company management has clearly said that they want to add about 200 to 250 stores every year. And obviously, KFC as a brand is a big crowd puller. The branding is in place, the distribution is in place. My sense is that unlike Jubilant Foodwork, which is now finding same store growth kind of being a challenge. In case of Devyani International, the operational metrics are not only strong, but they operate on a much lower base. The total count for stores is just about 875 odd, and the management is pretty confident that in the next 2 years, expansion will continue to be funded largely from internal accruals. So I would believe that you have a host of other companies like Sapphire Foods, Devyani International, Jubilant. There are many other companies which are planning to go public. What is important is the execution capability and the promoter track record. So I think in this aspect, I think Devyani can be a good choice, provided one has a 2 year kind of plus kind of time horizon. This is a company where I don't think you could see any equity dilution going ahead. And most importantly, ROE could possibly average around 20, 23% over the next, say, 2 to 3 years. And that is something which will obviously re-rate this stock significantly going ahead. So I think Devyani would be my number one choice. And obviously, Jubilant would be not be a buy. I would not be comfortable to buy Jubilant, at these, expensive valuations. So I think it's better that, if you have a Jubilant, you should convert it to Devyani, and obviously where the risk reward could be significantly better.
Thanks for that, Avinash. It's been a fascinating session with you, and I'm not sure if it's because of this session's timing that KKR is performing the way they are, or CB is performing so well. But nonetheless, we have one small question and one small thing we want to pick your brains about before we wrap up for the day. Uh, you've been in this space for the last 3 decades. Just help us understand: has the the fundamentals of investing changed from the time when you started working in this space to how people are investing today? Just help me understand what's the change in culture of investing over the last 3 decades.
I think most importantly, the basics of fundamental investing have remained the same. But I think today, new metrics of valuations have come, and every sector has to be seen from a different perspective. Like you can't evaluate a steel company with a QSR company or a FMCG company. So I think valuations are now going to be the most important aspect. In fact, 10 years back, valuations were not all that important because prices had not significantly moved up. But in today's markets, however good a company is, unless the valuation is in favor of the investor and the risk reward is in your favor, you will never be able to make big money. And I think the most important element when we talk about fundamental investments, Ashwin, is that the biggest challenge and the biggest opportunity for any analyst or any fundamental investor is to get into companies which are not regularly researched, which are completely ignored by the markets, and which don't have a bit of glamour or fashion on their names. I think that is where the big opportunity will come. And my clear hint is basically on the mid caps and on the small caps. This is a space where I would believe that over the next, say, 3 to 5 years, if you research properly and if you possibly do your number crunching properly, then you could possibly see a lot of wealth creation happening. As far as the overall approach to fundamental investing is concerned, I would believe that people are now looking at this very seriously. Number crunching apart, even the qualitative management commentary which comes from the companies is looked upon very closely, which was not the case about 5 to 10 years back. Companies have also started interacting with analysts, with investors, with institutions, and I think a lot of information today is available to the normal retail investor. I think what is required is a little bit of common sense, a little bit of reading, and obviously a little bit of logic when you look at investing in any companies, because it's not that only analysts can understand the companies better. I think even normal common investors have got a lot of common sense where they can obviously make good amount of money. But I think they need to combine all these qualities of reading, analyzing, and obviously understanding market psychology. See, because finally at the end of the day, the qualitative factors would be driven by the management, would be driven by the dividend payouts, would be driven by corporate governance issues. So all these things are outside the balance sheet. So I think it's a combination of all these factors which we are seeing now in fundamental investing, and this is something which was not prevalent about 10, 12, or 15 years back. I remember in the days when I started as an analyst, when the ring system was there, I think stock prices used to never behave very strongly on numbers. It was basically on hindsight and basically on market cover. Now all that has actually got completely neutralized, and I think more data points are being used. As I said earlier in my conversation, that please respect data and always analyze data properly, because data has got a lot of power in influencing the stock price either upwards or down.
For that, thanks a ton for that,
Awesome.
Avinash. It's really a delight to have you with us.
Awesome. Yeah, it was a really engaging session, and as the wickets for KKR kept falling, we ended up getting more and more listeners, and we're now up to almost 180. Guys, we've completely run out of time, but in case you want to go back and hear from the start of the conversation, this will be the first pinned post on our profile. So we would highly recommend that you go and hear Avinash's take on markets and lots of stocks, especially and sectors. As always, guys, if you're new, we do these spaces every Wednesday. So don't forget to follow us and sign up to our daily newsletter as well to stay up to date with markets. And with that, we'll wrap today's session. Thank you so much, Avinash and Ashwin, for doing
Yep.
this.
Been a
Yeah,
delight,
yeah.
man. We'll
Thank you,
catch you
Ashwin.
guys back. Thank
Yeah,
you,
thank
Avinash.
you.
Been a delight.